And Aaron Gibbs, CIO of Main Street Asset Management. A very good morning to you both. Aaron, I'll come to you first. What's your take as to whether we are into a new phase, a fresh bull market?
It's a bit of a head scratcher. Certainly looking at, obviously, just the performance, I'd have to say that it looks like we are. But when looking at what's driving this bull market, it's really all about interest rates and not about fundamentals. And so that's certainly concerning. We'd love to have all sides confirming that we are coming into a more robust period. And when you look at earnings estimates growth for the next 4 quarters, as we're basically finishing up the reporting seasons, it's really dismal. We're looking at growth rates for the next 2 quarters that have been cut in half, really down across the board. And we're seeing expanded valuations that are much higher than their 5-year averages. So, just how long can this sentiment last? And that's the concern, is just how long can we keep going off of expecting interest rates to slow and potentially even decline next year?
What about earnings season, though, in general, this past quarter? Because I think a lot of people's takes has been less bad than it could have been. Do you disagree with that?
Oh, so no, in the actual reports, sure, it's been good. We've had, better beats. It's just that, the market's always looking ahead for the next 12 months. And so I'm looking at how guidance has changed these estimates over the last month, the last 6 weeks. So how has the next 2 quarters changed our expectations? How has the quarters into 2023? And that's what's really concerning, is because generally we don't see these types of revisions for the future quarters so drastically and coming down so badly. So while companies have eked out and done pretty well and had some good beats, when you're looking forward, we're looking at even negative growth rates into 2023, so actual contractions again. And again, we're looking at growth rates that went from about 10% to about 5% on the S&P 500 for the second half of this year, so well below an inflation rate. And so that's the concern, is really when the takeaway of what did guidance mean to us. The guidance is really depressing.
In terms of valuation multiples, though, did they compress enough in the first half of the year to suggest a lowers in on that side of things?
So for the broader markets, when you're looking at mid caps or large caps, they at least came down to just about their 5-year average, but by no means would you call them cheap. They weren't at a massive discount compared to historical averages or compared to periods where we're having higher interest rates. The NASDAQ just briefly touched its 5-year averages, so just came down to an average level, and now is 20% higher. When you're looking at historical valuations and periods where you have rising interest rates, they still are above average. Certainly not as expensive as we went into just from 2 years ago, but by no means cheap.
And finally, Aaron, overall, are you adding a bit of risk to portfolios or taking profits after this nice bounce we've had?
So I know I'm sounding very negative and very hesitant. I have been adding, and I've been adding a lot of risk. One of my calls was Aspen Technology, so a mid-cap tech stock. I do believe that as long as this is going on and as long as that positive sentiment is going, run with it. I'm just saying be very careful, because there's still a little shakiness on the fundamental side. And so if you're adding risk, absolutely add stop losses. Make sure you have an exit strategy going in, so that if the trend does change, because this is really based off of treasury rates. And so if that changes, so is this trend, because it's not based off of fundamentals. And so I'm adding by as long as it's running. You don't want to be out, but certainly I'm just telling investors to be cautious, to be wary and ready to change.
Aaron Gibbs, thanks so much for joining us this morning. Very much